Did you know that 90% of day traders lose money? That's right. Despite the dream of quick profits, most day traders end up with less cash than they started. In fact, research shows that day trading is a risky game, with 80% of traders quitting within just 2 years. But here's the good news: you don't have to spend all day watching stock prices to get rich. There's another way to build long-lasting wealth, and it doesn't involve the stress of fast-paced trades. Whether it's swing trading or long-term investing, there are smarter strategies that can help you grow your wealth steadily and reliably. In this guide, we'll explore 3 popular strategies: day trading, swing trading, and long-term investing. You'll discover why patience might just be the most powerful tool in your investment journey, how to spot the right opportunities, and why quick trades often lead to quick losses. Ready to learn how to make your money work for you? Keep reading to find out which strategy could be your ticket to financial success. Chapter 1: The Riches of Patience. The power of long-term investing. Long-term investing is the tortoise to the hare of the stock market world. The magic of holding onto your stocks for years is in the power of compounding. Albert Einstein famously called it the 8th wonder of the world. When you invest in companies with solid fundamentals, you don't just earn from the stock price rising, but also from dividends that get reinvested to grow your wealth. Take Warren Buffett, for example. His most famous investment, Coca-Cola, has been part of his portfolio for over 30 years. The company's stock price didn't skyrocket overnight. But over time, as Coca-Cola expanded, its stock price grew by nearly 10,000%. Buffett's patience turned a simple investment into a fortune. If you can hold onto your investments for the long haul, you'll benefit from the market's inevitable ups and downs. The S&P 500 has an average annual return of about 10% over the last 90 years, despite experiencing multiple crashes, recessions, and bubbles. History shows that despite short-term market drops, long-term investors usually come out on top. A key factor here is buying stocks that are undervalued, stocks priced below their true value. You don't need to follow trends or worry about every market dip. As Peter Lynch, one of the most successful mutual fund managers, said, "The stock market is filled with individuals who know the price of everything, but the value of nothing." To make long-term investing work, avoid the temptation to check your portfolio daily. In fact, investors who try to time the market by constantly buying and selling often underperform those who simply hold. The trick is to invest in solid companies and trust them to grow over time. In the world of long-term investing, patience isn't just a virtue. It's the strategy that allows your investments to flourish. Chapter 2: The Art of the Swing. Trading with precision and timing. Swing trading isn't as frantic as day trading, but it's far from the slow, steady pace of long-term investing. Instead, swing trading involves capturing short to medium-term price moves over a period of days, weeks, or even months. The goal is to profit from price swings that are larger than what you'd get from short-term fluctuations. Successful swing traders use technical analysis to identify trends. They study price patterns, momentum indicators, and volume changes to anticipate when a stock is about to make a move. A popular swing trading tool is the Moving Average Convergence Divergence, MACD, which helps traders spot shifts in momentum. One example of a successful swing trade is Tesla, which experienced wild swings in 2020. Traders who entered during moments of price consolidation and exited during surges saw returns as high as 200% in just a few weeks. But timing is everything. Swing traders often capitalize on news events or earnings reports that cause stock prices to jump. Netflix's subscriber growth reports have often caused massive swings in its stock price, and swing traders with the right timing saw returns in the double digits in just days. However, it's not without risk. Swing traders face more volatility than long-term investors and are more prone to emotional decision-making. This is why discipline is key. You have to know when to cut your losses and when to hold for more profits. A common mistake is thinking a stock will go up forever. Always set stop-loss orders to protect your investments. Despite these challenges, swing trading can be highly rewarding for those who have the time and skill to analyze the markets. It's all about finding those moments of opportunity, those price swings that give you the chance to make a profitable move. If you're enjoying this guide and want to learn more tips and strategies on how to succeed in the stock market, make sure to subscribe to the channel for future updates. Chapter 3. The Day Trader's Mirage. Why instant riches can be deceiving. Day trading has an alluring appeal. You've seen the stories. A trader buys a stock in the morning, sells it by afternoon, and walks away with thousands of dollars. The promise of instant riches is a big draw for many. But there's a dark side to this fast-paced world. For starters, day trading isn't just about buying and selling. It's about speed, discipline, and avoiding emotional trading. To be successful, a day trader needs to make split-second decisions, often looking at charts and news sources every minute of the day. This constant attention can lead to burnout and poor decision-making under stress. In fact, studies show that 90% of day traders lose money. According to a 2017 paper by the Journal of Finance, the majority of day traders underperform the market, with many losing more money than they make. The short-term nature of day trading means you have to overcome transaction fees, slippage, and the challenge of constantly being right with your timing. One of the reasons why day trading is so tough is that you're battling against other traders, institutional algorithms, and the broader market. The market moves based on sentiment, data, and external events, and it's hard to predict short-term movements. Many day traders lose because they bet on the wrong price movements, and sometimes they don't even realize it until they've already lost. Moreover, the stress that comes with day trading can be overwhelming. A study by the National Institute of Mental Health found that individuals who engage in high-stress professions like day trading suffer from higher levels of anxiety and depression. It's easy to get caught up in the cycle of hoping for the next big win, but this can cloud your judgment and lead to poor risk management. If you're still drawn to day trading, it's crucial to have a solid risk management strategy in place. Only risk a small percentage of your capital on each trade, and always have an exit plan. Also, remember that day trading doesn't fit everyone's lifestyle. If you don't have the time or mental stamina to monitor markets all day, it might not be the right strategy for you. In the world of day trading, the promise of fast riches often ends up being a mirage, as many traders realize that quick profits are elusive and short-lived. The long-term winners in the stock market are those who can keep their cool, make disciplined decisions, and understand the risks involved. If you're learning something new here, don't forget to hit the subscribe button so you don't miss out on more valuable tips for your investment journey. Chapter 4. The Gold Mine of Undervalued Gems. Finding Hidden Value in Stocks. The secret to getting rich through investing lies in finding undervalued stocks, those that the market has overlooked or misjudged. Warren Buffett often talks about looking for companies with a strong competitive advantage and buying them when their stock price is below their true worth. The trick is to find hidden gems before everyone else does. One of the easiest ways to spot undervalued stocks is by looking at price-to-earnings ratios, P/E ratios. A lower P/E ratio relative to the industry average can indicate a stock is undervalued, though it's not always that simple. Sometimes a low P/E can be a sign of a company in trouble, so it's important to dig deeper into its fundamentals. Take the case of Amazon back in the early 2000s. In 2001, Amazon's stock price plummeted due to a tech bubble burst. The market saw it as just another e-commerce startup. However, value investors recognized its long-term potential. By 2009, Amazon's stock price had increased by nearly 500%. The lesson? Even solid companies can be undervalued during market corrections, but with the right research, you can make profits by identifying those that will rebound. Another strategy is to focus on companies that have strong cash flow but are being temporarily undervalued due to market fear. Take Apple during the early 2000s when it was struggling, yet still maintained strong cash flow and assets. Investors who saw the potential for growth got in early and enjoyed massive returns. But how do you find these undervalued gems? It's about going beyond surface-level numbers. Look for companies that have low debt, high return on equity, ROE, and are positioned in industries with growth potential. Sometimes, the best stocks are the ones no one is talking about. The beauty of value investing is that it doesn't require you to chase trends or market fads. Instead, it's about patience and discipline. Focus on companies with strong fundamentals that have temporarily fallen out of favor. Buy them when others are fearful, and you'll be in a position to profit when the market realizes their true worth. Chapter 5. The Magic of Dividends. How passive income can make you rich. If you want to build wealth without constantly watching the market, dividend investing could be the answer. Dividends are a form of passive income paid by companies to their shareholders, typically on a quarterly basis. What's powerful about dividends is that over time, they can significantly boost your returns without needing to sell your stocks. Think of dividends as interest payments on your investments. When companies pay dividends, they're sharing their profits with investors. If you reinvest those dividends into more shares, your wealth grows exponentially. This process is called dividend reinvestment, and it's a powerful tool for compounding returns. For example, Johnson & Johnson has increased its dividend every year for more than 50 years. An initial investment in 1960 of $1,000 would have turned into over $300,000 by 2020, thanks to dividends and the power of compounding. That's the kind of magic that dividend investing offers. But it's not just about finding any dividend stock. Focus on companies that have a history of consistent dividend payments and strong cash flow. Look for dividend aristocrats, companies that have raised their dividends for 25 consecutive years or more. These companies are typically stable, reliable, and resilient in the face of market downturns. The trick to making dividend investing work is to build a diversified portfolio. Diversification ensures that you aren't relying on just one or two companies for your income. With a well-balanced mix of dividend-paying stocks from various industries, you reduce risk and increase your chances of steady returns. Moreover, don't be fooled by high dividend yields. A yield that's too high can sometimes indicate that the company is in trouble. Always ensure the company has strong earnings to back up its dividend payouts. If a company's payout ratio is too high, it might not be sustainable in the long run. By focusing on dividends and reinvesting them, you're building a passive income stream that works for you while you sleep. Over time, you can reach a point where your dividends alone cover your living expenses, a powerful example of how patience and strategy can lead to financial freedom. Chapter 6. Beyond the Charts. How to build an investment mindset for wealth. Great investors don't just focus on stock prices, they focus on building a mindset for success. Whether you're day trading, swing trading, or investing for the long term, your mindset can be the difference between success and failure. Psychology plays a huge role in investing, and it's something that many overlook. The best investors are disciplined, and they make decisions based on logic, not emotions. One of the most famous quotes on investing comes from Warren Buffett. The stock market is a device for transferring money from the impatient to the patient. This highlights the importance of having a long-term perspective and not getting caught up in daily market noise. A critical part of developing the right mindset is embracing risk management. Great investors understand that not every trade will be a winner. They accept that losses are part of the game and don't let them shake their confidence. The key is to limit your losses and allow your winners to run. This is where strategies like setting stop-loss orders can help protect your capital. Another important factor is developing a growth mindset. Successful investors don't just invest in stocks, they invest in themselves. They constantly learn, read, and adapt to changing market conditions. Many of the most successful investors, like Charlie Munger, spend hours every day reading. The more you educate yourself, the more confident you'll be in your investment decisions. One strategy that can help build confidence is to track your progress. Many investors fail to keep records of their decisions and results. By tracking your investments, you can learn from your mistakes and improve over time. A great tool to do this is by keeping a journal of your trades and the thought process behind each one. Lastly, successful investors know the importance of emotional control. It's easy to let greed and fear cloud your judgment, but the best investors can stay calm during market volatility. When the market crashes or stocks plunge, they don't panic. Instead, they see it as an opportunity to buy great companies at a discount. Building an investment mindset takes time, but it's the foundation of becoming a successful investor. Whether you're trading or holding long-term, your mindset determines how you react to market swings, how you manage risk, and how you take advantage of opportunities. Master your mind, and you'll master investing. Don't forget to subscribe for more insights and updates on becoming a successful investor.